Hi everyone, I want to share you something today about trading Forex in a different way. No price action, no technical analysis. In this video, I want to present you in the picture of trading Forex fundamentally with news, data, economic outlook, geopolitics, events and stuff that can somehow provide you a clearer sight of what's going on in the market and why. So you can judge yourself how things works and how things will work. But before that, you have to prepare yourself. It isn't some shortcut that get you rich overnight, because fundamentals provide you an outlook of where it's heading overall rather than a quick solutions where you see this number crosses this line and it's a buy for you. It's not. It's like, for example, like what happened recently. I recorded I prepared everything in September, but because of the video takes a lot of time and I delay until today. So yeah, what happened last year with the rises of Trump coming into presidencies, this is what I write when I do the script. His presidency's policies and Janet Yellen's command, that means the Treasury of the US, their commands on the US debt, somehow hinting the weakness of the US dollar is a trend in the long run. Though there is an ongoing quantitative tightening reversing the dollar supply in the market, and a series of events that might favor rate high in between, and other currencies are performing worse with the policies, provide you an insight. Whatever currency you are trading with is against the dollar, which considered as a weak currency in the long run will highly increase your win rate as well as profitable trade, because this is a trend. My aim here is to provide you knowledge, making you not a fully economist but self-sufficient enough to be able to decide whether if a trade is towards favorable, in the gray zone, or non-favorable. I'll be using simple English here, so need not to worry about language barrier, plus I will make things really simple to understand. Really simple. If you have any questions, feel free to drop a comment. I'll reply you if I see it. So let's get started. The first thing we need to explore is what is Forex. I believe that many of you recognize Forex in the way that you're invested, if this is the appropriate word, by advertisement online about making money could be simply done with just a few clicks, if not taps on your phone. Well, and that's it. You downloaded the app and started the trading knowing nothing much about it. At the end, either lucks run with you or against you, and that's gambling. Forex is a foreign exchange which consists of the base currency exchanged to another currency. It's like think of an individual, or maybe think of you're holding a currency, maybe the euro, and that's the base currency, and then now you're looking to exchange to another currency, maybe the Japanese yen. When it's exchanged, and that's Forex. Simple. Interestingly, Forex used to be the private domain of the hedge funds, the global banks, and the wealthy private investor over the world. But changes in the recent decades, when the internet was introduced to the world, the entry to enter the Forex market has been gradually reduced due to the accessibility have never been so convenient before. Many small players like you and me are able to get access to the market and trade as well. We no longer require over $1 million to start a trading account. You have a phone, you have a bank card, you get an account, and then you can start trading. Though, having access to the market doesn't mean you can profit from the market, right? Like most people say, having an F1 doesn't mean you are capable of driving it, right? It doesn't really make sense, but somehow try to pretend to get the idea. There are people who start the trading knowing nothing much about it, and after a few minor winning trades, they went full force on zeroing your account. This is mostly due to high leverage trading, assuming Forex is their ATM, because they earn a little bit of the percentage, and then they got excited. They're lucky, and then they feel like they have some devil lucks, and then they went zeroing their account. So don't try to trade leverage. My warning here. I want you guys to recognize that trading consists of risks. There won't be a holy grail that provide you 100% winning rates trade, even though that my strategy doesn't work 100% as well. I'll try to explain on other videos. So you have to accept you could lose your funds when you risk the money on starting a trade. So before you start the trade, you have to decide what risk level is acceptable to you. In another word, your risk appetite. Either you're looking for a growth of maybe like 20% per year, or you're looking for a 2000% per year. You want to be a day trader that you'll be monitoring your trades 24/5, or you want to be a swing trader, require lesser time compared to the last one, or trade fundamentally that only look at the chart only a couple of times in the weeks, that in which you forecasted something where about a currency is heading in a couple of weeks or months later. Lesser stress, least time consuming. This is pretty important consider the amount of time, energy, and level of stress you could intake, not to mention if you could afford to lose the money for trading. Well, in my honest opinion, I'll rule out the high risk trading. It's like scalping, for example. Most people like to do scalping because they see like fast profit, but scalping, they consist of really high premium fees you have to pay every trade you open. You need to pay the fees to the brokers, and it's not profitable unless you got some 70% win rate strategy. Otherwise, it's not profitable. Okay, so because high risk trading, it costs they are more likely to be heading to zero than hero. So unless you're trading with a small amount of money, flipping it to 20 times isn't impossible. It's doable with high leverage trading, like trade the news or event in full margin, like like news event, right? People goes on full margin on trading the news, and then their account like got twice, and then growth by twice, or maybe like triple, right? It's possible, but it's kind of risky. There are more advantage on being a low risk trader than a high risk trader. Of course, you can combine the strategy around, right? There are differences between the speculation and investment. One is about making gain quickly, while another is growth. We will expand on future video as well. It is important to recognize the benefit of planning a trade than not. Now let's continue to the next part. What is currency? In a straight sense, currency acts as a middleman of exchanging goods, meaning you're holding these notes in which the value is recognized by the market to exchange for other goods, no matter physical goods, digital assets, or other currencies. Or to sound more professionally, currency is the medium of exchange. Suppose when it was traded and circulated within nationwide, people generally don't feel the strength of their currencies. But when it's extended to trading against other currencies, the currency value will be determined and based by the market. I hope it isn't difficult to understand. It's like you have two person in the market arguing about what the product should be pricing at. Maybe $10 or maybe like $100. The big numbers. You could imagine that when negotiating the price when purchasing a product in the store. I'm not sure about for now, but it used to be possible on bargaining the price when the trade route wasn't as advanced as now. So they both bargain on the price, and until both agree on the price, because it's generally you and him, right? So you both agree the price. And when it's standing in the market of 100 billion people, the price of this product, the currency, was agreed by the majority. That's how you get the currency value. It's created through many tradings in the market where everyone finally agreed the price. Though we have to recognize that it isn't the numbers of traders that matter that affect the price, but volume, which the trading volume are determined by the bigger players that hold huge amount of the specified currency. The big players meaning the central bank, the banks, the hedge funds, the wealthy players commonly known for the whale, etc. I hope it's simple to understand. If you understand, maybe just give a thumbs up. We need to have a basic ideas of how these fundamentals works. So how does a currency gain or lose value? How does it works? It would be a little complex to explain. It would be more appropriate for me to expand it on another video, but basically the idea of the currency gain value is the market bought and hold a lot of the specified currency. It's like they bought maybe the US dollar, for example, and this money weren't circulating in the market. That means the Forex market. Instead, they went for investment like the housing, the stock, or businesses like purchasing materials, or simply holding the money for a safe haven, or maybe like holding the money for like interest rate. For when these currency weren't circulating in the market for trade, they were like a portion of the currency being locked within their economy. While there are lesser currency for trade in the market, the buyer will need to pay more to purchase them because there are rarer supply in the market, and so it appreciates. And how they lose in value? The opposite. People no longer hold the currency and dump it on the market for trade or swap to other currency. They will in turn lose value, and this is the core reason how all this thing works. It basically works like a product. So imagine if a specified currency was dumped or bought in a large scale, that will drive the currency in one way greatly. And how this happens? When there are like a big news or maybe like a shock event that shock the market, they forces them to push in one way, and then there goes like forces all traders to move along one way. And actually, right, personally, when you see such thing happen, right, it's really a good opportunity. But I don't encourage speculation yet. I'm not financial licensed. But when you see such thing happen, right, it would be worth to risk a little bit. Again, not financial advice. Again, not financial advice. So continue. Yet, what will cause that? Okay, what will cause all these currency to move around? One of the critical thing is that informations like the economic data, economic outlook, central bank interest rate, political outlook because of the possibles of the policy changes, etc. So these information will influence, or maybe those people they are influenced by this news, and they will move according to what the market react. So they will follow the trend along it. And this information are important given that, according to the source, an estimate number of over 90% of the Forex daily trading volume are contributed by speculations, meaning the currency are moved by traders who are looking to profit by buying and selling the currency actively. While 75% of the volume from these 90% were traded on the major currency pair, meaning the currency that are mostly traded by traders, which include, of course, the US dollar, the euro, the British pound, the Japanese yen, known for the major currency. These few currency, right, was contribute about 75% volume from the 90%. Yeah, it's pretty big. Those currency that has lesser volume in trading, like the Mexican dollar, the Turkey lira, are known for exotic currencies. The main differences between the major and exotic currency is liquidity. This is not too important to understand, but let's learn something. Liquidity, in simple words, are the amount of trades of the product. For example, you have the US dollar, have people trade every millisecond, where the market are feel full with market interest. People are looking to buy and sell actively. They call it high liquidity. In the opposite, you have the Turkey lira, for example. I mean, example, if it's not too offensive to the people in the Turkey. If you have the Turkey audience who are watching, Sorry. Okay. Nobody is interested on trading it. There are lesser open order for the Turkey lira. Remember the example we raised earlier about 2% bargaining on the price of the product? When there are lesser participants in the market, the price will stagnant for a while until a trade is executed in the market. And then when it executed, it jumped to the executed price. Like the USD TRY, for example, is trading at $100, for example, and then it's stagnant for a few minutes, and then it jumped to maybe like $100.20 after when the trade was executed in the market. We call it low liquidity because there are no open buying orders and no open selling orders. We will wait really long until someone, okay, I accept your order. You get it? Since trades are executed in banks, and when banks doesn't operate 24 hours 7 and rest during the weekends, therefore executable trades in the Forex market only open for 24 hours for 5 days, open during the Mondays and close during the after Fridays. Though, depending on your time zone, for the West, the market open in the afternoon of the Sunday. Although the market is live for 24 hours, yet the Forex market is divided into 4 main trading sessions, which are the Tokyo, London, New York, and Sydney sessions. Please note the main trading session, your minor one as well. If you are familiar with banks, they open for business during the morning and close on the evening, roughly about like 10 hours of working time, while banks in different regions operate during the day and close in the evening, right? Similarly, the Forex market trading session are based on the region of the operation hours of these banks. Forex market trading session may be crucial, especially you're trading major currency targeting news, especially on those country, like maybe like New York, London, Tokyo, and Sydney. News, economic data, event, and after impact release during this time, crucial if you're a day trader and news trader, especially if you could make use of the high liquidity of the market for quick trading. It's like the market jumped to the price point that you want in just maybe seconds, high liquidity. Aside from that, any news that happened during the weekend or ending of Friday will be resumed trading during the opening of the market on Monday. For example, like if war on a certain country started during the weekend, the speculator will take advantage and place order during the opening market on Monday. And when the Europe or US market trading session starts, these speculators will gradually place their bet for what they expect and believe the outcome would be, and appreciations or depreciation. So, plausibly, weekend may not be a holiday to a certain group of people. Plausibly. Okay, let's continue to the next one. The USD index is commonly used indicator to judge the strength of the dollar, yet how it is made. This is not a discovery channel, but you're here to learn things too. The USD index is the average value of the US dollar against a basket of 6 other major currencies that are traded in the market, which include the euro, the Japanese yen, the British pound, Canadian dollar, the Swedish krona, and then the Swiss franc. You could imagine it as a fight against the USD against the other 6 currencies. When the USD index is climbing up, it literally means the USD is strengthening against other 6 currencies, representing the strength of the dollar overall. Like, since 6 of these major currencies already reflected were the major amount of trading volume in the Forex market, so somehow 6 of these are more than enough to tell the strength of the US dollar, like what we said earlier, right? The major currency took about 75% of the 90%, right? So when you see the USD index goes up, generally represent the strength of the dollar. And next, we want to explore about the correlation between the USD and other financial market like the gold, the stock market, housing, etc. Gold is not something unfamiliar to you. It's the sound money and was once used as a base for currency creation. And now we are sitting in the credit era. Gold is no longer has its special role, but still has, right? But acting as industrial raw material and then somewhat a commodity to hedge against inflation. Gold price, they usually fluctuate high when the market sentiment, they switch from risk on to risk off. I think we will save this part on another video, simply too long to expand it here. Basically, as for the correlation between gold and currency, when you see gold soar up high, most usually the market participate on the sentiment reverse at some point. So when you see gold is spike up, the market is fearful the currency in your hand devalue for number of reasons. Think of if you're a trader and with a big capital, if you believe that the billions that you're holding will depreciate by some 10%, will you be placing a portion to the precious metal? Where we human have the consensus of gold serve some way as an asset to hedge against inflation? Most probably yes, right? And then next up is the crude oil. Was once an important commodity because oil represent energy, and then energy represent the fundamentals, the fuel of an economy. Well, there might be a decade more the crude oil energy has its special placement. The importance of it will gradually goes down. Nonetheless, the impact is served in the financial market since clean green energy are becoming dirt cheap now. As for now, the price of the crude oil indirectly represents the economic outlook it has for the world. While it doesn't directly impact the currency of a country, but it did be interesting to identify which country relay crude oil, the traditional energy, the most as energy sources. Generally, when crude oil is cheap, it provides cheaper costs on building up economy. You can also define it as cheap energy sources. In most cases, that when a country economy is down, this is a portion for economy recovery because it's cheap. Suppose when the running cost of an economy is low, producing, transportation, and trading will stick at the low price boundary. And according to most economic educational material, central bank will keep the interest rate low to provide liquidity circulation in the economy to help the economy run. And when interest rate is low, people generally borrow money out for uses. Like they borrow it from bank for other uses like investment, right? Or maybe like build up a business, etc. They don't store it, if you get the idea. And then the opposite will be the exact opposite. When crude oil serves as an independent energy sources of a country is expensive, the running cost of the economy indirectly lifted up. And when that happens, everyone in the chain, the supply chain, the production chain, the transportation chain, bala chain, all raises its costs. The central bank will very high likely to use the tool they have on their hand. The legendary song named the interest rate sought hike up the interest rate until nobody in the market is able to sustain the high cost production until they collapse. Meanwhile, money are most likely to keep in the bank scenes. If banks offer high interest rate around what the central bank offer, they are most likely to store the money in the bank if it's too complicated to understand. So crude oil is a mirror of an economy somewhat. Hope you get the picture. And then the stock market. Well, stock market doesn't have any direct correlation with the currency, but like what we have learned earlier about currency appreciation is about when the market hosts a lot of a country currency, which lock in the country rather than placing on the market for trade, that currency will appreciate. Stock market play this role as well, since any international funds wanted to trade a certain stock, they will first need to buy their currency first, then be able to trade their stock, right? If that specified stock delisted in the global market. Though, while stock market has this unique role of locking the liquidity in the market, you will need to weigh which territory reserve most of the fund. Like what happened to the Japanese stock market last year, Nikkei. Part of the reason Nikkei rose was their currency being dirt cheap, and at the same time, the central bank of the Japan offered dirt cheap Japanese yen with the interest rate of roughly 0.25% or 25 BP, which used to be negative interest rate. So a portion of the money went to the stock market, and then a portion of the money went swapped to other currencies. I hope if it isn't too complex to you. Really simple, truly really simple. And then next off, we will be exploring about the major players in the forex market. Who are the players in the market which are capable of moving the currency rate? So the Bank of International Settlement, the BIS data suggests that over 90% of the daily forex trading volume are based on speculation. The major players that play such role are the hedgers, the financial investors, the global investment flows. They contribute over 90% of the daily forex trading volume. Yeah, even retail was included in it. So speculators, the reason they show up in the market is that to profit off from any of the directional moves in the market, including us. This includes the hedge funds. Hedge fund is sort of like take it as a group of people that have loads of money gathered, making use of the leverage offered by the market to trade about 5 to 10 times more than the funds they are holding on hands. The sum of the money they manage under hedge funds, they vary between ranging from millions to billions. When it multiplied by 5 to 10 times of its base money, it's kind of huge, and it's capable to move the market in any desired direction in a short time frame, in case if they dump billions in the market at once. Yeah. And then we have the individual traders, ranging from small to big time traders. They contribute a sum of the forex daily trading volume as well. Additionally, well, technology weren't as how it used to be in the old days. Like robot trading is approachable for anyone now. Like I have created a video about it too. You have to chart GPT, you have the DeepSeek. When you talk to them, and then they will source you the code, and then you can use the code directly. So with these, right, the frequency of order placed in the day has accelerated, increased a lot. And interestingly, when everyone in this group of the people that uses the most in the market has a consensus on using the same strategy, like support and resistance, for example, they work at some point. And then the hedger, not to be confused with the hedge fund. Hedger, sort of like the business on raw material production, like silver, for example, a factory. They are looking to lock their price, the silver they produce on hand. Say if the silver they are producing at the time is $20 per ounce, and the market is currently sitting at $40, they will place a short position on the market to hedge, or simply lock their profit. If you understand what I mean, it's like when you have one silver produced right in the market, you couldn't find anyone to sell off to gain a profit, right? You just temporarily put a sell contract in the market as equal to how much stock you have on hand, right? So that basically locked the price of the what it offer from the market. It's like the same thing as well for business owner who have business in different countries. Say for example, a cookie shop located in Japan, when the currency they are earning is depreciating, they will place a short order on the Japanese yen to lock the current profit they have on hand. I think the first example is easier to understand. These people, when they're in action, they make like big moves. And then government and central banks, they are the largest holder of foreign currencies. One of the main reasons a country has foreign currency reserve built up was the capital investment flows or trade surplus. These players don't usually move the money unless something big happens, like currencies of their country are being in the wanted list, if you get what I mean. Like for example, I can't tell. You could imagine if a country suffered a dump on currency by Titanic. I mean, when they suffer an attack on their national currency, and if they have a huge reserve of foreign currency, they will sell these currency from their reserve and then buy back their own currency, providing a support from falling further. In short, such event rarely happen unless a country is fundamentally performing badly, if you understand what I mean. So finally, these transactions will be made in between the so-called interbank. Interbank is like, imagine you have people trading with each other, and then when you swap the role to banks, and that's called interbank. They execute our trade and at the same time providing liquidity to the market. Next, we will be talking about how to trade currency. Trading currency is slightly different than trading stock or trading product, just slightly different. In the traditional way, if you're trading currency as a product, assuming that the forecast of a currency is heading to appreciation, you would buy it and await the market to side with you. Everyone buy it together, and when it appreciated, you gain in value, and you would sell it, right? The thing is that the product you're holding is currency. You can exchange back to currency, right? This sentence might sound a little bit confused, but literally, if you're holding US dollar, and when US dollar appreciated, okay, now you want to sell it. You sold the product in exchange of what? In exchange of the US dollar, you gain US dollar, and then you exchange for US dollar. That's simply impossible. You would exchange to other product that could be collectibles and stuff, but when you're trading Forex, you will be exchanging the US dollar to other currency. Does this make sense to you? Now let's take the most popular major currency pair, the Euro USD. Sorry, EUR USD. What does that mean? So the first symbol is the base currency, while the one behind it is the code currency. As of how to read it, simple. Imagine the base currency is in your hand, the left one, and you're looking to trade for the code currency, the right one. So now let's say that the EUR USD is currently sitting at $1.20. You have the euro on hand, and then you're looking to trade for dollar. Your euro worth 1.2 US dollar. It's simple, right? I bet that anyone who went for traveling knows how to read all these codes. But when it comes to trading, you're neutral. You're neither in any positions of buying or selling any currency pair, because you're yet to be involved in any trading. Continue with any of the trading platform comes with the bid and ask button. It can be simplified to buy and sell if it's a little too complex to understand. They have another set of names that when you frequently lurking around forum, you will often read the word long or short, but that mostly apply in the stock market, like long the dollar and short the yen. The long is same as the word bid and buy, Well, the short is the same as us and sell. You don't ask me how this thing came. They just appear and then I just learn it. Simple as that. So back to the currency code again. We have the base currency on the left and then the code currency on the right. So assuming if we were to buy the base currency, we will be buying the base currency against the code currency, right? Now take EUR USD for example. If we were to buy the base currency EUR, then we will be selling the dollar in return. Say you notice that the upcoming NFP data could be a negative sign for the growth in the dollar, and then you are looking to short the dollar. But what is the other currency should you be trading against? Now suppose you should be trading the weak against the strong for better return, right? If EUR is recovering from economic downturn, the PMI is estimated to be a positive sign for the growth of the euro. You will be shorting dollar and longing euro at the same time. And what currency pair should you be trading? The EUR USD. And how should it be executed? You will be placing a buy order on EUR USD. Because you're buying euro against the US dollar. If in the opposite, positive news for the US dollar but negative news for the euro, you will be shorting euro while longing the US dollar. That means you sell EUR USD. Kind of might sound a little confusing, but it's pretty straightforward. Just try it out on the demo account and you will get it right away. So currency trading is somewhat similar to a tug war game. If you could picture it in your mind, it's like one force fell and then another arises, and then one rose up and then the other fall. If both were equally strong, and then they will remain static. We have mentioned about a few major currencies during the explanations of what's the US dollar index, and then here we have the symbols for them. You need to have the basic of knowledge which symbol represent which currency, just in case if you have mistaken it as something else, which will be a tragedy for your trading career. So USD is not euro and then EUR is not US dollar. Don't get mistaken. So anyway, I'll just put a graph here and then and just read it as well. The USD stands for US dollar, EUR stands for euro, GBP stands for British pound, the nickname steering or cable. And then the JPY stands for the Japanese yen, the nickname yen. The CHF stands for Swiss franc or the Switzerland currency or nickname Swissy. The AUD stands for the Australian dollar, the nickname Aussie or Aus. The NZD stands for the New Zealand dollar or the nickname Kiwi. You can find the full list of currency ISO code on Wikipedia as well. Though you have a vast number of different currency in the world, but the most traded currency in the world are known for the US dollar, for the reason they are strategically located themselves well during multiple crises throughout history. We will expand it on future videos, kind of interesting. Therefore, they expanded and exported their currency overseas and have majority holding their currency for trades, investment, etc. You will have people pay attention more on US economic data, US economic outlook, US political outlook, etc. rather than paying attention on other countries. Though it doesn't mean that data events on other countries are not important. Just simply mean that the trading opportunity based from the frequency of the data event on US dollar and the volatility are greater compared to other currencies. Like, consider if you are to monitor data event on Japan, you will most likely to pay attention only on their trade balance, their bonds, their interest rate, and then the central bank decisions, a few of them. Yet, when it comes for United States of America, you will monitor almost all of them. The ISM, PMI, CPI, and employment claim, blah blah blah. Yeah. This part about trading platform user interface will be a little boring. Suppose if you register yourself a demo trading account, it will be much more simple for you than me explaining this dry stuff. I recommend registering an account, a demo account yourself to play around. It's costless and doesn't require any legal information like ID card or face scanning. I think it's better only include the important stuff here. Leverage. So obviously we don't have a millions to trade currency, and therefore we will be lending money from the broker, so we could have more money to get involved in the market. By default, you are asked for your risk tolerance and then the leverage level for your account, which the leverage is a tool for you to multiply the amount of the base money you have deposited to your broker. Suppose if you select 1-to-1 leverage, meaning you're trading and paying the full value without lending money from the broker. So imagine you're buying a book, the Forex Trading for Dummies, pricing at $100. With the 1-to-1 leverage, you're paying a full value of it. You need about $100 to trade the book. So with 1-to-2, you're paying half of it. I hope you get the picture. But a stronger example is that if you were to trade one standard lot, that means 100,000 units, assuming you are trading EUR USD. And assuming if EUR USD currently sitting at $1, yes, $1, just to skip those unwanted complex calculations, 1-to-1 leverage, you are required about 100,000 to open the trade. Yeah. And when it's 1-to-10, you will only need 1/10 of the cost. 1-to-100 is 1% of the cost. But make sure you select a balanced one, because when you select a high leverage, although the margin required is low, right? But there are times that when you mistakenly enter another zero on opening a trade, right? You open a larger volume, you accidentally open a larger volume, it would be really a disastrous move. So try to pick a one that is like 1-to-100 or 1-to-20, something like that. And then next is the margin. Margin is sort of like deposit the fund to the broker. It's like whenever you open the trade, like what we have introduced earlier, the higher leverage setting your account has, the lower the cost required to open the trade, right? The cost is the margin here. When you select 1-to-1 leverage and trade on the standard lot on EUR USD, your funds, 100,000, are required to be temporarily held in the hand of the broker. If this is a better explanation, your balance and, to be exact, equity are required to exceed the margin level in order to open more trades. So pause for a while here. Please digest the information here first. And then if the margin level drop below 50% of your liquidity, now say for example we talk about 100,000, right? If you goes 1-to-1 leverage, you will need to like temporarily hold 100,000 to your broker. But your real balance, or what they call equity, right, when it drops below 50%, so when it goes to 50,000 and then it reaches like 50% of the margin level, right? So your broker, they will trigger a margin call and close out on your trades. Though the 50% we talked about earlier, margin call, right, they varies between brokers depending on their terms. So the high leverage provide you more space for trading aggressively. And then keep in mind, overtrade might not be a good idea. Although there is not much differences other than your money were being temporarily held by your broker, it's better to find a balanced leverage that suits your trading style, or select a lower leverage just in case if you went rampage, you goes mad and trade emotionally after streaks of losing trades. So kind of reminder of shouldn't risk all. Calculating profit and losses very necessarily nowadays. It literally appears on the screen, so would you just skip it? Lot sizes. I will simply place a graph here, a picture with 1,000 words. Well, basically these lot sizes represent the size of the currency you are trading. You are given the option to choose the lot sizes when registering an account on the smaller Forex broker. Those more reputed Forex broker all use the standard lot size as their standard. If you're unsure how much one standard lot sizes was, try it on the demo account. Then the rollover and interest rate. The rollover is about having the trading position hold overnight. Now you're trading currency. Any other place on the market indirectly mean you're holding the currency against the other currency, right? On one hand, you're holding the currency you borrow. On the other hand, you're holding the currency you borrow too, but sold it to the market. And that's called shorting the market. Currency to be specific, because you need to have the product first in order to sell it to the market. Sounds confusing, but when you open a trade, it will be one against the other. While central bank in countries offer different interest rate, most positive interest rate, well, one for sure, it will be either negative or near zero interest rate due to some historical event, which is the Japanese yen. So say for example, if the Federal Reserve in the United States of America offer a 5.5 interest rate, while the Bank of Japan offer a 0% interest rate, when you're buying the USD against the yen, you'll be earning a positive swap. Though it won't be the rate of 5.5% exactly, mainly because your broker will mark up the fees included on it, but at least it's positive. And when you keep a position open overnight, you earn interest. Yet you're shorting USD against the Japanese yen, it will reverse the logic. And then you'll be paying the interest rate for holding overnight then. And it will be much more expensive because there's a markup in your broker. These information are mostly available on your broker web pages or on the trading platform. You could refer those if this sounds too confusing. And if you can't find them, try the shortcut, ask their live chart. And then spread is the price differences between the buying and selling price. That's what your broker earns mainly from your trades, if not overnight fees and other hidden stuff if they're a legit broker. Executing a trade is really straightforward. You're given the button of buy and sell as explained earlier. Depending on which currency you had a crush on, buy that currency against the currency you felt is going downward. Closing the trade would be as simple as pushing the button too. And finally, we completed this part. A reminder here, starting up a demo account is always recommended to get yourself familiar with the platform and all settings. It's better to try it out first before writing the F1, cause in case if anything bad happen, like you accidentally increase the lot size by 10 times while executing a trade, better get yourself familiar and look out with the potential pit hole there first. Next part, we'll be talking about big pictures. We have already got ourselves with information so earlier. I hope we paved the path for better understanding here. Like understanding what's the main driver of the appreciations of a currency is basically that when the market holds more of a specified currency and they store it and buy them for the circulating supply in the market is lower, instead of circulating in the Forex market to swap for other currency, right? Now, what's the reason could drive the market on storing your currency? What's the attractive for them to store the specified currency? Do you have any ideas? Now, okay, what's the point of you learning to trade Forex. Profit, right? The main driver of the appreciations of the currency are mainly profit driven. The money attracts the money. It's a money game the speculators join the party for, right? If not, then under worse circumstances, they swap to the specified currency to hedge against devaluation on the worst performing one, and that so-called the safe haven currency. The so-called term safe haven currency, does this make sense to you? And then, what is the most influencing news, events, data that brought impact to these speculators? The central bank interest rate decisions, the monetary policies, and then the bigger one, like related to the trades or maybe what the market is paying attention on. And what triggered the changes on these? Economic growth and inflation data are mostly the driven for the monetary policy and interest rate decisions. And here you might be scratching your head about, oh no, no worries. I'll make it as simple as possible to follow. So those are the most attention-paying information about the market. Other than that, it will be presidential elections, economic policy, geopolitical risks, trade conflicts, terror attacks, big move on the stock market, etc. But no worries, one by one. You know that ever since we live in the new era of the big data, market is unlike the past, information are common than it ever was. We have to recognize which information are valuable and will be considered by the market, differentiating who is the commander and whose word has more weight. Okay, like for example, you have the Secretary of the Commerce of the United States, the Janet Raimondo says. She says this in the public. Would it prefer an immediate rate cut to prevent the economic condition from worsening? This is from last year. Okay, she's the Commerce Department, which has no right on enforcing any policy unrelated to her field. In these circumstances, it is better to ignore her statement. Though her words weren't actually meaningless, more like she has a stance for saying that for reasons. When you're observing for the possible changes on monetary and interest rate decisions, you should pay attention to the chairman of the Federal Reserve and the Secretary of the Treasury for the United States. Their words weigh more in the market. Considering if the principal guardians for real estate is location, then the principal guardians in the currency trading would be interest rate, and interest rate. It's important to repeat the important things for 3 times in a row. Interest rate is one of the few tools a central bank possesses and was used to influence and lead or guide, whichever word is appropriate, the economic environment to a specific directions. Since the main objective as a speculator is to profit out from the market, in case if you have banks that offer you a risk-free money like 5.5 interest rate annually, would you consider storing your money there? Certainly, most of the people would. And when this becomes the consensus of the market, swapping to a specified currency will drive that currency value up in the long run. Sort of an important indicator for the trend traders or like trend reversal trader. Though it is important to recognize that the market consistently adjusts itself based on the outlook of the market, meaning not only the market will start running when the policy starts shifting, but will be moving as well when it's about to shift. It's called expectation. It's kind of like if you knew something is about to happen and you run before others. So interest rate expectation is pretty much an important indicator to follow as well. Now, who has the decision making for the interest rate? The policy makers of the central banks. Yet, what are the indicators these policy makers to start shifting its policies? The significant changes in the economic performance and outlook. Yet then, What are the indicators for these policymakers to weigh and forecast the economy performance, the economic data? The official objective of a central bank are promoting price stability and restraining inflation, while the other is about promoting sustainability economic growth. So they want to compress inflation at the same time promote growth. But their main focus was mostly inflation. Funny though, their concept about restraining inflation was basically that the economy is overheated and they have to cool it down by increasing the running cost. That means the interest rate. Funny. Silence. So basically, there are three main reasons of the causes of inflation. It's kind of long to expand it here, so we will save it on another video. And then increasing the interest rate does actually increase the running cost of the economy, mainly because the cost of borrowing from the bank has increased, in which these commercial banks follow the central bank rate, actually higher than that, which affects businesses from expanding, like purchasing materials, increase labor shifts, researching costs, blah blah blah. Then eventually, when businesses struggle to maintain profit, they stop selling their product at higher price. If they can't sustain such condition, they will collapse, which somehow cool down the inflation, achieving the goal the central bank was looking for, according to them. And then, according to them again, if the central banks keeping the interest rate low actually lower the cost of borrowing, provide businesses a better environment on establishing and expanding their businesses, and then continue with, they want to ensure the economy is not overheated or stagnant, so keeping the interest rate in the balanced zone is what they focus on. Though actually there weren't any issue with the statement, but if the causes of the inflation was not feeling well, sorry. So monetary policy generally falls onto two categories: the expansionary or restrictive, or another set of terms is that the easy money and tight money. Basically, expansionary is lowering the interest rate to stimulate the economy, while restrictive is tightening the tap to fight inflations. These terms are commonly used on news publications, so better remember them. M2, or the money supply, refers to the amount of money circulating in the economy. When the central banks and commercial banks increases the money supply significantly, there is a possibility that banks may lower the borrowing costs, since lending is one of their income stream, one of them. As for how they increase the money supply, here is a hint. Banks only require to keep 10% of the deposito money in reserve. Excuse me. And then we have the unconventional easing, a large-scale asset of purchase program, frequently known for QE, or quantitative easing. In a straight sense of how QE works is sort of like the Federal Reserve, the Fed. They have a huge chunks of money printed. I'm sorry, sir. They have a huge chunk of money, and then they are buying whatever property or asset in the market, like bonds or securities, or the money or the currency goes from the Federal Reserve to the market. So the Federal Reserve holding the so-called asset, while the market is holding the money the Fed has. So this is one of the ways to drive up the quantity of the money supply too. When the country have huge sum of money supply in hand and they want the money to circulate to the economy in order to people to borrow them, they will most likely to reduce the interest rate. Like when you're approached by a banker offering you a loan, you goes like, holy cow, is this free money? And that happened on after 2008, which the market is more favor on believing these two. Alternatively, the market would also consider the value of money could be saturated as the money supply grows. And then decoding the messages from the Monetary Policy Committee members. Not all the central banker was weighed equally. It's like in office as well. Not everyone was weighed equally. You need to understand that. The committee responsible for the setting of the interest rate, commonly known for the monetary policy committees, or what they call MPCs, have the significant power, of course, voting for the setting of the interest rate. The Federal Reserve, the Fed's Federal Open Market Committee, or the FOMC, is one of them, and is pretty much important speaker for delivering the message to the market. While the FOMC operates under the one-member, one-vote system, the chairman of the central bank holds more weight in public statement. The market often views the chairman's word as a whole of the entire committee stance, though basically their stand could be categorized as either hawkish or dovish, or in between them, and just these three stances only. Most of the time, hawkish as how it was deemed. Hawk is like flying upward, meaning their monetary policies are heading towards the tightening, meaning increase the interest rate, tightening the cap. Or the dovish is the opposite. They call it the expansionary route. Okay, now the jump to the next one. The currency market in the intervention, it wasn't unfamiliar to the place in the currency market between the year 2023 and 2024. One of the G7 members suffered a consistent currency devaluations over a couple of years ever since the rate hike in the US happened, and has a couple of times launched currency interventions. I do believe you know which country was that. And when the currency is particularly bad for a country at a certain point, like a long-term currency devaluation for a couple of years, and when the government, were to intervene the currency value, they don't usually go on to burn the currency reserve they collected through tradings. Okay, strategy, right? They will most likely to throw mixed messages to the market as a warning first. If that doesn't work, their choice will narrow down to throwing off their currency reserve on buying back their currency to support the currency value. Though, the interesting part is that although a government owns $1 trillion of foreign reserve, this ammo isn't enough to go against the markets. Since the daily trading volume of the Forex has reached over like 7 trillions per day according to the BIS, the Bank of International Settlements, it's like you dump a rock into the sea, all you could hear is a dome, and that's it. Though whenever a government starting to intervene the Forex market, depending on the speculators, the participants, if they believe the words thrown by the officials, if they believe, then these speculators might ride along the pump done by them, create a trend shift temporarily, and notably the amount of ammo the foreign reserve can be used by a government for interventions are limited and is countable, meaning the amount of intervention and the strength of the intervention will highly depend, which they assume, when is the best time to start the retaliation. Okay, if it's not too complex to understand. We have talked about the central banks, the quantitative easing, and the currency interventions, but who are the key players in different countries? In the US, the Department of the Treasury has legal rights over currency matters, including printing notes, minting coins, selling bonds, etc. The Federal Reserve, or the Fed, on the other hand, is responsible for setting monetary policy, including adjust the central bank interest rate. For the euro, the European Central Bank, or the ECB, is responsibility for both currency and monetary policy under the agreement of the creations of the currency in 1999, the euro. The ECB is composed of presidents of the central banks of the member of the European nations, meaning that you have like the president from different country within the European nation, right, the EU. With the president of the ECB acts as the group's policy maker and spokesman. It seems like the Federal Reserve, the FOMC as well. Now for the Japan, the Minister of Finance, or MOF, an individual, a person, a human, not to be mistaken as a group of people, institutions, is responsible for Japan's currency metal. Aside from that, they have better rights on influencing economic affairs compared to the Bank of Japan and the central bank. Messages and any changes coming out from the Minister of Finance are all worth paying attention to, including the changes on the post of Vice Minister of Finance. For Switzerland, the Swiss National Bank, or SNB, is in charge of the Swiss franc, along with the responsibility of the setting of the monetary policy. Since the Switzerland is located in the euro, more likely the setting of the monetary policy will be concerning on the euro and its economy. Like the flash crash happened for the EUR CHF near after the euro debt crisis between 2009 and 2010. Yeah. And then move on to the miscellaneous part, gauging the credit risk. We are in the credit era right now, so it's common country have debts, but the question lies on if a country could be able to return them based on the bonds they issues. Like what they call it, the debt to GDP is a measurement of a country if they could maintain its debt level or the debt growth. Yes, you didn't heard wrongly, the debt growth. And then the financial stability is about in the fate of investor had in the country. So imagine if a country suffer financial instability, like the country that is now ruled by a chainsaw guy, if you know what I mean. Reflects if the currency is still safe to hold. Consider investor would worry that the country could go bankrupt, and also worrying that will be defaulted, like the euro debt crisis. Meaning the central bank could no longer support the value on bonds and notes printed. Issued by them. Geopolitical risks and events. The meaning for geopolitics could be really broad. The range could extend from politics to natural disasters to wars, bringing a disruptions global or individual region economy performance. Because the currency market consists of international capital flows, if these capital felt threatened and they felt that their wealth are no longer safe on a specific region for reasons, they could withdraw their funds. Therefore, the currency could be affected positively or negatively and shift their funds somewhere else. It's crucial to determine if the impact is what was brought was temporarily or long term. And then elections in individual countries could be considered as the geopolitical risk as well, when the outcome of the election might lead to a change in the government or economy policies. Like, for example, bringing back job opportunity could be interpreted as building more factories or attract investors that could invest more on real economy or providing more subsidies to them, etc., depending on the policies and promises they suggest. Gauging risk sentiment is kind of crucial as a currency trader too. This risk sentiment is somehow impacted by the interest rate offered by the central bank. The risk on is about the average traders in the market took the risk on investing on all kinds of assets, including most risky assets like the Bitcoin and stocks. If we look back in history, the cost was mainly because the money is too cheap to borrow from the bank. Consider the interest rate for a loan is quite low, so they just took the money they loan and invest it elsewhere. The risk off is about the average trader in the market withdrawing the investment they had and move their funds to a safer place like the government bonds or currency for the central bank provide a better interest rate to earn the investment rate they offer, or something else they feel that the value depreciate slower. Alternatively, this could be known for the deleverage. There are other risk indicators than the interest rate itself. The VIX index, for example, also known for the CBOE volatility index, is commonly used to gauge risk in the stock market. The VIX measures market expectation of volatility. A higher VIX value indicates increased market volatility, often reflects a greater uncertainty or fear among investors. When the VIX is high, it suggests a risk-on environment with the heightened market activity. In the opposite, when the VIX slides downward, it may signal the market is shifting toward risk-off, where the market is moving towards to safer or less volatile investments like the currencies, bonds, or maybe like gold we have introduced earlier. And then the government bond yield. Just in case if you don't understand what it is, the bond is a note printed by the government, issued by the government they are going to spend, but in promise to pay you back in the period of time. Like 10 years bond, meaning the 10 years later. They will pay you back in 10 years later. But at the current moment, you will be giving them the money first. Then they will pay you back with the defined time frame with the interest rate. Sort of like gift card. You sold your credit to them. Government bond yield acts relatively the same as central bank offering attractive interest rate. You give them say $100 and then they promise you to give a 5% return annually. You make like 5% per year, and then when the time frame reaches, they return you the $100 and you earn the interest rate along it. The yield rate fluctuates as the market bought or sold in the secondary market. When the demand of the bonds is higher and was bought by the market, the yield rate will decrease. The opposite for when the demand is low, nobody buys them, the yield rate will increase. This is sort of like a measurement as for where the money is heading. For money who sits here are generally known for the risk of money. Monitoring the bond yield could give you an idea of the risk settlement as well. If you understand, I'll try to expand a little bit. Like the yield rate, for example, when you're trying to sell things, right? When nobody wants to buy, you lower your price, right? So other could profit from your buy, right? Imagine that someone else is a businessman and then you're a production company. So you produce something at $2 and then they bought it and sell it at $5, right? But when a lot of the demand in the market, say for example, like 100 persons, maybe 1,000 persons, they buy it all for $5 from you, and then your a lot of demands, your product has a lot of demands, you could increase your $2 to $4 based on the market condition. These apply on the yield rate as well. When a lot of the people buys, right, you no longer need to provide higher interest rate to make them attractive to be available for sell, right? That's what it generally means. Skip on to the next part. Gold, a precious metal, which as well is a risk indicator. You know, risk on and risk off will like seesaw. If the capital sense something unusual, they will move a portion of their funds they believe is safe for them. These precious metals and other commodities like the raw material as well will generally are the same. But if you ask me, capitals prefer those that can generate them interest even when they're asleep. So when you see a risk on market stock and like those are more risky asset like the Bitcoin, right? They are more attractive because they generate them more money as they sleep. Now let's continue to the next section. I'm not sure if you have noticed or not, I have many times used the word market. I'm not sure if you totally understand. This word is pretty important for it represents the conscience of the trader. Now imagine when the market is on a strong buying trend, do you think the small time trader will follow, or yet will you follow the trend? What about a strong call from the president which goes with low interest rate, low tax, low energy price? If you have huge majority of the players in the currency market goes for one direction of a specified currency, you have the market creating a long-term trend for the policies the president called for is consensus. I have explained it on the starting, but it should be fine to repeat here. Anyway, you know that everyone has a different level of understanding and interpret on a single message. Some goes with figuring out by combining the behavior of the commenter if their words are worth listening. Some goes with if the fundamentals support your words. Some goes with his words way lesser than the data I have on my hand. Different people have different views, right, and interpretation on the words, right? Same with the economic data as is in its core, the same. Sorry, what I mean is that the same as well for economy data. Everyone has different view on the economy data. For the player to drop their assumption if it's a positive or the negative sign, it's like you have a group of players. They interpret a set of messages as the EUR USD moving above 1.5, and then you have another set of player looking for 0.9. Two different type of people, and they are pulling against each other for the expectation they assume. Now the thing is that you're here to take a ride when the market is struggling on a consolidation before a trend is formed. It's time for you to load up yourself with homeworks like the rest of the analysts. Research online, read out what other analysts says, and pick your team, and then wait. Yet, where are the required resources for you to start your research? There are many free resources available online for currency traders like us, such as the investing.com, bloomberg.com, or the fxstreet.com. These platforms, they provide valuable information including the economy calendars, education material, updated news, and analysis from various experts like those from the Owanda, etc. I did encourage viewers. Hey, the person who are sitting in front of the screen watching the video right now, you. It's recommended to listen more opinion, no matter it's good or bad. There are always changes happening in the world every moment, and staying informed requires listening to a wide range of perspective. Yet, it is important to recognize that the website I have mentioned are mostly repost content and not from the origin news sources. To get yourself for the latest updated news, consider following sites like the bloomberg.com or the reuters.com and the marketwatch.com. And then with the rises of common to have smartphone on hands nowadays and the popularity of a feature within smartphones, they have such thing called the news feed, right? Like you have Facebook, they have news feed. You can actually follow their social media account like the Twitter or maybe X, what they call now. It's a weird name for live updates. If you have extra D space in your phone, you could consider downloading your apps, for they also offer push notifications live feeds through the mobile apps as well, keeping yourself updated. One thing to note is that analysts don't usually provide your homework info to you. I mean, it's obvious that nobody would want to share their homework to you, right? Instead, they usually hide words within words, so soaking yourself long enough will get you more ideas as to how to decode the messages, and also help you on forecasting the market outlook. Keeping a pair of the critical eyes is always important. It is also important to identify if the content you're reading is either rumor or fact-based. You know that fake news is so common right nowadays. If there are rumors or fact-based or just mix-up, this is a little boring, but always ask yourself, what is the source of the information? You need to differentiate the fact from opinion or rumors, since it's pretty much costless to create rumors in modern days right now. False information could destroy your trades if not careful. And then another question is that how old is the information? You need to gauge the timelines of the information and then identify to which, if the market has already acted on, if they have already priced in, it's critical for news traders especially. I was kind of skeptic about how news trader was named. Should it be named economic data trader instead? Anyway, one of the most important tools for data event trader is the economic calendar, which provide a list of data to be released on a specific time. Don't ask me why. The time for when this economic data release is fixed. Like for US, they always release unemployment claims every Thursday. Please allow me to continue with the last part. On the economic calendar, they usually counts with the 3 ratings or stars if you prefer. They have this low, and then the mid, high impact data events. These scheduled data allow us trader to prepare which data is worth trading and which is not, for it's risky. Depending on the risk sentiment in the market, the market situation, it's important to recognize that although the site define them as low impact data, like we mentioned, we have the low and then the mid and then the high impact data events, right, for the data that is going to release. But if the market focus shifted to that specific scope, low impact data could turn into a high impact data too, if you understand what I mean. In case you have already know a few things about the numbers beside the event name in the economic calendars in this picture. For example, on the unemployment claim, beside it is the actual, forecast, and previous. Some websites also provide a graph and its historical data like the forexfactory.com. The numbers in the forecast weren't made up by some random guys, but from combinations of different sources. If you want a specific source, you can look for it. Like one of the examples is the Bloomberg. They have their own team. So these forecast data weren't entirely meaningless. It's considered as a working indicator for the forex trader like us. There are traders adjust their trades accordingly when these forecasted numbers was reported. Please note, it's the forecasted data, not the actual one. And then here's the headache part to digest. Try to slow down a little bit. Now, say that the upcoming ISM data event is forecasted to be 52, which the previous one was the 55. Pressure of the trader might adjust their trades accordingly. Like, for example, if you believe the economy should be on the path to expanding aggressively from the recovery, your assumption that ISM should be at least like above 55 yet. For example, the forecast has moved near to the 50 level, the neutral zone. And then you might pull up your trades for you are skeptic and unsure. Similarly, it applies to the same as other as well. There are traders who trade before the release of the news data. Another case is that some traders assume that the ISM manufacturing index to be a negative sign for the growth for the dollar strength. That goes with it should be below the level based on the previous one, 55. No matter what is the actual data, this guy, a trader, he is towards holding a short position on the dollar against other currencies, say the euro. The trader will then assume if the release of the actual data of the ISM is 55, and then he will take 10 pips. If it's 53, and then he will take 15 pips. If it's like 52, and then he will take 25 pips. If it's below 50, that surprise the market, which is out of expectation, and then he will take over 50 pips. This strategy is pretty common among the news traders, if you get the idea. Now, this economic data usually comes with a short-term impact first and then follow a longer one after. It's pretty common to see that the currency goes the reverse in direction as the data first release and then follow up after. And then trending. It's like the market is fighting for the direction they believe it should be heading to, and then after they all made the final votes with the majority votes on the single directions. The team, we jump to another one. The theme of the market is especially important to this. It's like if the market is heading towards the stagflations or depressions, generally every positive news on the currency will hardly sustain. It's important. It's really important for real, the theme of the market. And then moving forward to the next sections, we often heard about all the numbers in the economic data like the CPI, the PPI, the PMI, ISM, blah blah, all the random numbers, but kind of out of clue what it actually means. Or you know a little bit about this stuff, you know what the number means, but still treat them as an individual, an independent number. It won't make any sense. It's crucial to picture this number as a whole, like picturing a full image of a city rather than just building itself. Economy work on the basic concept of supply and demand. You have to supply, you have to demand. You have to demand, you will have to supply to fill them. They both affect each other. Although the world is changing constantly, this fundamental will never change. I want to add something about this number, right? Whatever you see on the data was actually a lagging indicator. There was first research what was happening in the economy, and then later they put it into numbers. So there is a lagging in between. So what you see right now was actually like a month ago, maybe like 2 months ago, etc. Okay, and I'll move on to explain what this data means and try to explain what role it plays in the big picture. And I do hope you try to question and figure it out yourself. It's better than you to get the idea than me explaining to you. The economy breaks into 3 sectors, mainly the labor market, the consumer, and the business sector. For the labor market, labor is considered as the fuel of the economy. The fundamentals, they brought up productions, they feed the demand of the market. They are a mid to long-term indicators of the performance of the economy outlook. It could be also served as an indicator for the Forex trader as well. When the growth of the labor market is positive, reflects more money are being spent on wages because the bosses, your boss or whatever, right? The person on the upward, they need to pay the wages to their workers. And when these wages are being spent, as a consumer, it provides a positive growth to the businesses. The store owner, then they might be looking for an expansion as well when they see growth in sales, growth in business. And when they expanded their business, they might hire people too. Job creation will increase then. These are known for economy expansion, which also indirectly fuel the credit expansion too, providing more liquidity to the market. Or you can define it as more money being circulating in the market. It's like generally when people have a better job or business, they have better credits to apply for loans on purchasing stuff they want, like houses or luxury products. People see this as a positive sign for the growth of the economy and the currency value. Please note, this is just part of the picture. You have the trade policies, monetary policies, and other elements have not been factored in it yet. So the growth of the labor market is stable, that's fine. But if things went opposite and there is a progressive weakness in the labor market, the market might question if the economy could sustain. Investors might consider transfer their money to somewhere else. Then, in the perspective of central bank, they might consider overheated labor market as a sign of inflation pressures. According to them, it goes with as the demand outspaces supply, prices for goods and services may arise, leading to inflation. In an overheated labor market, wage growth can further contribute to inflation as businesses raise price to offset higher labor costs. Please note, is not a leading indicator of the cause of the inflation, just part of the picture. Just part of it. Okay, the NFP or non-farm payroll or the non-farm employment change is categorized within the labor market too. The NFP represent the total numbers of job creation excluding farming, government, private household, and non-profit organizations. Anything above 0 in NFP is job creation in the economy. And don't even think this figure could go below 0, is simply impossible. So NFP is considered a data of job creation, though the lowest expectation from most of the economies in the market of the US is 150,000 jobs creation every single month as a past performance. Anything lower than that might raise skepticism among speculators, though depending on situations. And then we have the unemployment rate, measure those who are unemployed and are seeking for jobs in percentage. If the unemployment rate is growing, meaning more people fail to apply for job. If it's decreasing, then the jobs are being filled and replaced. we have the ADP, the non-farm employment change, or ADP report in short, a report showing up 2 days before the NFP, which tracks job changes in private sector excluding the government and farming industry. ADP is usually an indicator for the NFP. It's like the people get an estimate idea of the outcome of the NFP from the data of the ADP. If it's too confusing, it's like ADP, they come out first, right? And then they see it's like as a weather report what's going to happen for the NFP. So when the ADP is going downward, most likely they believe the NFP will go down as well. And then the average hourly earning month to month. It measures the changes in employment wages. It is considered the strength of a consumer if they have better wages to spend. And then you have the unemployment claim, reported every Thursday of the week, measures the numbers of individuals who file for unemployment insurance for the first time during the week. It is categorized under the labor market, so still is an indicator signaling the overall economy health. More people remain unemployed, lesser spending from consumer. And then the consumer part now. The personal consumption contributes over 2/3 of the economy in the US, even more in other countries. When you have strong spender in your country, you will automatically attract foreigners to invest in your country. But the labor market is considered the fundamental for good wages. Here, we will be continue to explain data related to consumer spending to give you a better idea what these US data are. The retail sales. Retail sales, they measures and is the primary indicators of the personal spending in the US, which covers like most of the purchases the American made from purchasing stuff online through Amazon's, or maybe a jar of the jelly and or like peanut butter in the Walmart. This report is an indicator of the strength of personal consumptions. Though, do note that these data may influenced by season also as well as sharp price fluctuations. For example, the average household will go out to purchase goods and gifts, which gifting is a culture in the Western society. So it's pretty common to see better data in Q4 and price fluctuation for gasoline price. All of these influence will reflect into the retail sales report. And then we have the housings or real estates. It's kind of an important major factors behind the consumer spending. It's kind of like typically reflects the purchasing power of the middle and upper class. Like ever since the housing price have inflated so much over the decades. Well, it also reflects the wealth it has for the middle and upper class, like speculators like us, right? We may take these data as an indicator if the economy is running healthy. And then like maybe a portion of the speculators may assume the more money you have, the more money you are likely to spend, and that will bring a positive growth in consumer spending. So when you see a lot of people trade on house, right, meaning there are more demand and also more money in the market flowing. While people may have different opinions, some goes with the rising of housing price is a support of consumption through the wealth effect. But personally, I don't think so. For the reason, a huge portion of the real estate is held under a group of people under a certain generation, like the baby boom. So the home sales data is more reliable to me, reflecting the wealth of the middle class and above. Anyway, for existing homes, the National Association of Realtors, the NAR, is the one who releases these data, the existing homes. And then within it, pre-existing homes, which including the condos, make up around 85% of all home sales within this existing home data. The report gives an annualized sales rate, but like people are more interested in how much the rate changes from month to month, and then things like the median home price and the number of unsold homes, we kind of like help shows how the market is moving. And then the sales only counted once the home is officially sold on this existing report. Another report to watch is the pending home sales, which looks at homes which sign contract that haven't closed yet. It means you sign something but it hasn't closed yet. This often used as to predict how future sales of the existing homes will trend or go. Okay, understand it? And then the next one is the business level data report. We have discussed the importance of the labor market and how it reflects the strength of consumer spending, right? So what role do business level data report play? Considering that both ultimately point towards the consumer market, in the perspective of business owner, not necessarily all of them focus on sales, right? If consumer is the end user of a product, then the creations of the product where the costs are primarily incurred. Then imagine the business owner no longer importing goods. What message could it be signaling to the market? But then there are also like business owners that already stock items and goods before like months ago. So you kind of like need to see the situation. So anyway, let's start with the ISM, also known as Institute for Supply Management. It's a data that is created in the calculation of regional and national indices of the current business conditions and the future outlook based on survey of about 300 purchasing manager, which they are asked with questions like their business conditions, including like employment, productions, new orders, prices, suppliers, deliveries, and inventories, blah blah blah, something like that. It's kind of like a confidence index for purchasing managers, giving us an insight into the current business condition and their future outlook in their point of views. Regarding of the data is that above 50 refers to expansion, below 50 signals for contractions. And then we have next one we have the PMI, also known as the Chicago Purchasing Manager Index. Is the key regional manufacturing activity index in the Chicago as it was named. Since the Chicago area and the Midwest region are still the significant hubs of the manufacturing activity in the US based on the geography location, market sometimes view it as a leading indicator that have more influence than the ISM manufacturing report itself. There are many reasons for the purchasing managers to stop heading forwards. Like some of them when they think the future outlook isn't positive in fear of like recessions, or maybe they have already previously stocked their goods like what I've talked earlier, or because of the seasonal factors, etc. You have to dig into details or read more analysis and data for more ideas what's happening lately. And then the Philadelphia Fed Manufacturing Index, one of the major Fed indices to be reported each month, generally covering over 250 manufacturers in the manufacturing sectors in Pennsylvania, New Jersey, and Delaware. Which includes sub-indices on new orders, employments, inventory, prices, and so on. Anything above the zero is considered an improvement. Below it is worsening condition. Another business level data to pay attention to. And then we have the industrial production measures the amount of output generated by the nation's factories, mines, and utilities on a monthly basis. This industrial production is viewed as an indication of the changes in the broader economy. This manufacturing sector is often viewed as the leading indicator for the overall business cycles. Any changes here will lead investors to raise their eyebrows. And then we have the capacity utilization rate. It's a percentage of usage of the available resources by manufacturers, miners, and utilities. Anything above 80% may raise the attention of investors, like for example if they use over the capacity it has. There will be like some lagging of the available resources in the market because they use over it, right? So the market people, the business owner, the purchasing manager, they might bid on the same product at a higher price, which might lead to an inflation. And below below the 80% or maybe a certain level, and then no alarming, nothing happens, no worries, be happy. Yeah, something like that. It's one of the inflation related indicator the policy might consider. And then the Fed Beige Book is a compilation of regional economy ratings rated by the Fed's 12 distinct banks based on surveys and things happened and reported between local business leaders and economies. And it serves as the basis of economy discussions at the upcoming FOMC meetings. Yep. And then next up, we have the inflation reports. I guess you have already know what's inflation by now. For sure, you have experienced yourself in recent years. Inflation report is to gauge the differences of the price levels of goods and services. Also, kind of one of the important factors for central banks for decision making on interest rate changes. There are different types of inflation report, with some focusing a group of items while others excluding them. Like, for example, the core basis of the inflation data, like what they known for the core CPI, core PPI, something like that. For example, they remove the the volatile price movement items like energy, like gasolines, to get the number least bouncies. Like, for example, when you see like oil prices, they turn from negative $40 to like $140, right? They flip from negative $40 to $140. How do you calculate that? So many times. So these prices, right, they fluctuate a lot. So when it key into the cost CPI, right, it wouldn't be making sense. So they move it out, make it least bouncy. So you see the cost CPI only changes minor, maybe from like 0.2% to maybe like 0.3%, something like that. If they include the oil price and energy price and etc., something like that, right, it would be like 0.2%, and another month so they jump up to 1%, and so they take off all the very volatile price movement items to make it like, yeah, something like that, including the rentals also. So anyway, oftentimes you will see wordings like the MOM or the YOY. MOM, they stands for the month to month, and YOY, they stands for the year to year. Is kind of like simple to understand, right? To compare the data from, like compare the data from month to month, and then compare the data from year to year. Yeah, something like that. So while month to month, they provide you a clearer scope of the trend, while year to year, they provide you the insight if things have already settled. The standard of the average inflation rate of a country, according to the Federal Reserve policy, is 2%. What's considered as the rate of a healthy economy. Anything above it would alarm that inflation is soaring up high again. Yeah, something like that. Move on to the explanation for the data. The Consumer Price Index, or the CPI, is the most familiar indicator when it comes to picturing inflation, right? You often hear it, right? It measures the cost of a basket of goods and services at the consumer or retail level. It's like what you, the price that you are paying, not the price you guys, we retailers and consumer, we are gonna pay. The price, remember the price. And then we have the Producer Price Index, the PPI. They measure the changes in prices at producers and wholesale level. These prices affect the cost of goods and services that comes from these producers. And PPI is often seen as an early indicator of inflation. It's considered the upstream in the inflation process, as it reflects the cost before they reach to consumers. So it's kind of like making a potential leading indicator for the future inflation trend. If you don't understand, it's like PPI is the business guy. They produce something, and then if they hike up the price, right? And then we have these like sales chains sales chain, which comes from the business owner, they produce item, and then they go to the middleman that put it on the store and sell it to the consumer. So in between this chain, right, they hike up the price. If they the source hike up the price, the middleman will hike up the price to earn more of the profit margin, right? And then the consumer need to pay more. So PPI is early indicator of the future inflation trend. Then continue next with the personal consumption expenditure price index, or the PCE price index. So we previously have the CPI that measure the price consumer and retailers are paying, right? Yet for the PCE is about the spending of the from the average consumer. The PCE index is more of an inflation indicator that are more widely considered by the Federal Reserve. Comparing to CPI and PCE, CPI is sort of like the price you're paying. Like imagine that a basket of items, which one of the item within it, right, increased by twice or maybe thrice the price. And then imagine there's one kind of egg in the category that sells $1,000, hike up from $1 to $1,000 because of maybe seasonal reasons or maybe whatnot, or other other reasons. Well, other eggs, right, they maybe sell like 1 cent. And then yeah, these data are accounted into CPI too. Whereas PCE accounts a broader range of spending, like including insurance, medics, transportation, etc., that giving a bigger picture on the consumer behavior, because you spend them, you really spend them, not what was listed in the market like CPI. And when these inflation data show sign of hitting up, the Federal Reserve may adjust its interest rate accordingly, or maybe like most countries' central bank as well. And then next up with the trade and current balance. The trade and current balance are the two most important reports for the Forex market, as they reflect a country's economy strength. These reports, they suggest whether the economy is performing well, giving investors a reason to invest or withdraw their investment. Though consider that not all currencies in the world have equal strength, not all countries have the same structure to uphold the value of their currencies. Some countries specifically, this report trade and current balance is typically important to them. Like country like Japan. Sorry. And what is trade balance? Trade balance, they measure the differences between a nation export and its import. If the nation import more than they export, please note these data are accounted in currency value. So it's basically about money flowing in or out. It's not about items or products, or how many products you sell, how many products you import. No, it's about in currency, in money. If you're flowing outward or you're flowing inward. Now, when they import more than they export, it's like basically they are spending more money than they earn, and it has a technical term known for the trade deficits. Yet on the other way around, when they export more than they spend, meaning they are making money than they import goods, known for trade surplus. It's ideally the same as managing a business, if you could imagine. The current account balance is about, it tracks the flow of the money into and out of a country, which including the trades like income from investment and financial transfers, is sort of like knowing how much the country has, and if the money is flowing inward or outward, the current balance. Then the current account also either in deficits or surplus, which reflects whether a country is a net borrower or lender to the rest of the world. It's like you have a lot of money in bank and you're looking to lend out the money to others, known for surplus. And on the opposite, when you run out of money, you will most likely to apply for a loan from others, known for deficits. Generally is the same meaning. Then we have the government debt and the budget deficits. Debts nowadays is a very common word people doesn't feel ashamed telling about. Country is the same. It is really common that country have debts, and near to none a country doesn't have in modern day. Government debt, in my opinion, isn't worth too much attention. The reason how financial system works now is totally different than it is in the past. It's totally okay to have debts, even huge debts, when you have the capacity of looks like you can return them. You have a good credit rating, you have a good trade balance, don't worry, be happy, you're fine. But when a country doesn't have the capability of returning the debt, investors may be afraid of these countries have their debts defaulted, ended up the promises the government made, like like bonds they issues, the debts they owns, poof, I can't pay you back, guys, do whatever you want, something like that. And when these countries are weak internally, in terms like economy or maybe like political, they might get attacked, and their currency value might drop like a rock overnight, depending on how the big funds, things like the whales, if they want to pull out their funds. Unlike other data reports we have mentioned earlier, there aren't any data released that specifically cover the debt situation in any major economies, so we will have to explore it in an alternative ways. That would include the budgets and deficit forecast, which is issued individually by government of where about their spending, and if their spending level is healthy, considering if they could achieve the result they plan in a timely manner, like they have like big achievement, they want to build a lot of MRT, bullet train, etc. If they can pay off, and whether if they can sustain such spending without creating too much risk. Sort of like a risk assessment. Like for example, if a country that aren't performing well in decades and suddenly announce a large expansion in budget, would raise the investor eyebrows. Then the investor goes like, is he serious? Where the money came from, etc., something like that. And then next we have the government bond yield, which refers to the interest rate the government promises to pay the bondholders for purchasing its bonds. The relationship between a bond price and the yield rate works like a seesaw. When nobody buys the bonds, the price of the bond decreases, and so the yield rate increases to attract investors. And when there are demand in the market, investors buying them aggressively, the price of the bond increases, yet the yield rate decreases. If you get the idea, it's like seesaw, right? So government bond yield acts sort of like an indicator how the market trusts if the government will be able to return them the money plus the interest within the promises time frame. So high bond yield rate not only indicates the confidence the investor have towards the government, but also its financial health. And then the government bond auctions or debt auctions, whichever name you want to use. Now, the bond price we are seeing on the websites was actually the price traded in the secondary market that was first purchased on the primary market, which is the government bond auctions we are talking about. Now, the bonds issued by government always sticking around like $100, the par value, like more or less depending on the market situations, like the interest rate and demand. Now, the amount of bonds issued by the government is not specified until notified on these government bond auctions, and generally not always all of them were sold to investors, and it's not uncommon to be unsold. And when there are remaining bonds that found unsold in the primary market, they will be bought by the market maker and then provide liquidity to the secondary market. These data could be found on economic data, but it's possible to read it on news websites like Reuters or Bloomberg. And then when bonds aren't fully sold in the market, also indirectly signal the confidence the investor had towards the government and its financial health too. Yeah, and additionally, when you see like most of the investors, they bought like the short-term bond, maybe like the 3 months, 6 months, maybe a year, right? The short-term bond, instead of buying all those like long-term bond like 10 years, 20 years, 30 years, something like that, they might be afraid, the investor might be afraid of there is some turmoil in the market might be happening too. So it's kind of like reflecting what the investor thinks, kind of like an critical indicator, a most used indicator what the investor thinks towards to the economy health. So next up is the sovereign credit ratings. There are assessments given by the major credit ratings agencies like Moody's, S&P, and Fitch. They were kind of like reflecting country credits. You often see like these country have like AAA credit ratings, and then like AA credit ratings, blah blah blah, something like that. Their worthiness. These ratings, AAA, AA, they have a very significant impact on the financial market. When a downgrade is announced by these agencies, right, you better hope things stop worsening. When they announce negative, like downgrading from A to maybe like B or maybe like C, right, the negative reaction in the financial assets will be really severe. Maybe like falling in the stock market, bond price, and currency value, and it brings a strong chain reaction. You would be like poof, mind blown seeing that. And then you might have investors who lose confidence in the country if they are able to repay the debts as soon as they found this out. So now we have pretty much covered most of the important economy data report and other key factors that influence the currency value. And next we will be focusing on both the characteristics of other currencies than the dollar, which took us a lot of time covering them, as well as the economy data report that influence their currency value. Though please be reminded, the majority of the speculators in the market, they mostly focus on the news circulating in the dollar than other currency, mainly because of the trading size it has in the market. Like, like USA, a tiny sneeze from some country have greater impact than ground-shaking news on most country. I mean, like, you could picture that major currency and mostly trade in the market. Rarely people participate in those rally moves unless the tide is turning. Now let's start with the euro, a currency that was introduced on the 1st of January on 1999 by the ECB, or the European Central Bank, kind of a broader version of the European Union, to strengthen the economy integrations and to support easier cross-border trade. It also helped associated countries on simplifying their transactions. That means using the same currency without swapping in and out, which helps from like daily trading obstacles, and then it helps economy stability and reduces the possibility of currency being speculated, what they know as the currency attack, whichever words you like to use. For euro, is now the second most traded currency in the world. And then if we pay attention to the news, it's mostly either Germany or France that's on the headline. And the European Central Bank, of course, somehow reflects the strength of the Reichs, generally falls on both these hands, the Germany and France. We are not here for politics, of course. Anyway, since the euro, this currency is more towards to the trade-dependent trades, and when the Germany are known for the world's top standard in manufacturing, Germany will be the focus on economy stability. While France was known for one of the greatest military powerhouse in the world, they will be focused on the political stability. You might be wondering if I make sense. Yes, actually. Germany is the largest economy in European Union and contribute most to the EU's GDP. And France, they're kinda brave to speak and do things in the way they want it. Anyway, there are three report data are considered high impact for the euro currency and are worth paying attention to, which are the ZEV survey, PFO and GFK survey, and the Purchasing Manager Index, the PMIs. Let's talk about the ZEW Financial Market Survey first. A report made by surveying approximately over like 300 economies and analysts, a sentiment about forecasting on the economy performance in Germany, either in optimistics or pessimistics, like what they think about the future in Germany, either cloudy or maybe a clear bright sky. This data is pretty simple to read. If the number is positive, then they're confident about the future. If it's negative, then they're not positive of the future. Yeah, simple. And then the IFO and the GFK survey. The IFO is a corporate sentiment survey that queries businesses across Germany on the current sentiment and how business is expected to develop over the next 6 months. And then the GFK survey is a monthly measure of consumers' confidence. And then we have the PMIs, or the Purchasing Manager Index, produced by a data frame called market. Similar to the Chicago PMI we have referred earlier, still a key regional manufacturing and service activity indexes, but for Germany, France, and the whole Eurozone. Continue with the Japanese yen. The Japan is known for its technology innovations and globally popular brands, mostly in electronics and mobile sectors, like game consoles and fuel-efficient cars. Japan is also categorized as a trade-dependent economy with the reliance on exports for its economic growth, also for the stability for the currency value. Trade balance, as mentioned earlier, are especially important for countries like Japan. If a trade balance of a country has declined over a decade, it's probably their products are no longer competitive, could result a decline in currency value in the long term, which is an important factor that shouldn't be overlooked. And then we have the Tenkan Index, is a survey of business outlook conducted by the Bank of Japan and releases quarterly. It mainly breaks into 4 readings, which are the current conditions and future outlooks, from both large manufacturers and non-manufacturers. And then next with the British pounds, the currency of the United Kingdom. If any one of you are unfamiliar with, the British pound, unlike the two we have mentioned earlier, which both support the currency value, are more towards to the trades. And British pound is kind of like they are one of the oldest currency in the world, in the market. So the currency value is influenced by mixed factors like trade, finance, global sentiments, and strong historical foundations. Things that were established in the past still value today. Anyway, the focus will be on the Bank of England Monetary Policy Committee meetings, or the MPC official bank rate votes. This report releases every single month that shows the voting result of the most recent interest rate decisions by them, the committees. The voting result represent in 3 digits with a dash in between that could be found in most economic calendar. The first shows the number of the members who voted for a rate increase. The second one, which is the middle, is for a rate cut. And then the third one is on the right, is for keeping the rate unchanged. It's kind of an important indicator where the rate is heading, which is similar with the rate possibility for the Federal Reserve on the Fed watch. And then the Bank of England quarterly inflation report, as suggested in its theme, releases quarterly forecasting of the growth and inflation over the next 2 years, which can have a significant impact on the interest rate outlook. And then the PMI, or the Purchasing Manager Index, same as before, is produced by a data frame called market, a key regional manufacturing, constructions and service activity index. And then next up with the loonie, or the Canadian dollars, known for the strong associated export with oil, natural resources, agriculture goods, and manufacturer goods, as well as tourism and real estates. People usually think Canada when they are looking to migrate for its education for the next generations and policy for retirements, etc. Trades play a significant role in Canada economy and is contributing heavily to its GDP, so Canadian dollar is towards to the trade-dependent currencies. The Canadian data mirror US data in many aspects similarly. And here are a few important Canadian data or indicator to watch out. The Bank of Canadian Monetary Policy Report. It released quarterly. It's about the Governor of Bank of Canada providing the insight of the economic conditions and the inflation in the view of the local banks. The information that are stated in the report are generally out of focus. They are using it as an indicator to shape their monetary policy or interest rate decision in the future. The IV Purchasing Manager Index, or IV PMI in short, a survey of 175 purchasing managers in different sectors. Respondents are asked to rate their relative level of business conditions, including employment, productions, new autos, prices, supplier deliveries, and inventories. Similar to the PMI report we have mentioned earlier, the figure is above 50, expansions, below 50, contractions. Next, with the Australian dollar, another country that are rich in natural resources, also in agricultural goods like milk especially. Australia shares similarities with New Zealand's in terms of being resources-dependent economies. Oftentimes, when both of these currency moves, they move together. But the reason is due to their similarity in economy drivers. The data that we're looking at for the Australian dollar is the RBA rate decisions, or the RBA cash rate. Yep, it is released at the rate decisions. And the RBA rate statement, or the Reserve Bank of Australia statement, a statement that provides information regarding monetary policy, commentary on the economic conditions that influence the rate decisions, also discuss the economy outlook and hints the market the possible outcome of the future rate decisions. Similar to the Fed statement after the rate decisions, it's like after the rate decisions that the Federal Reserve provide, right? They give a speech to the public saying what they're gonna do, what they see, what they think about the future economy, blah blah blah, and their rate decisions. And next up with the New Zealand dollar. We last mentioned earlier about NZD shares similarities with the Australian dollar, though New Zealand dollar are more towards rich in exporting agriculture goods and expanding to other fields as well. Looks like it is. So the data that are worth paying attention at the time, right, are the official cash rate or the interest rate of the Reserve Bank of New Zealand's. The RBNZ, or the Reserve Bank of the New Zealand statements, is the same as the previous one we mentioned. And then last with the Chinese renminbi, or the Chinese yuan, or the CNY, or the RMB, or whichever names you prefer. China has been a rising and leading power in many fields, including global economic power in recent years. From what I've noticed is they aren't interested on expanding the financial field, or at least in the aggressive way like stock market. And real estate. Actually, they are more towards to industrial expansions. The Chinese yuan is hugely influenced by government policies. If they go swift, they won't allow their currency to further depreciate. Of course, not as direct as I said. Then you won't see it depreciate much or sharp depreciations. For the reason they have been the top exporter in the world, collecting more foreigners reserve than you could imagine. Hardly any speculator could move the currency value sharp in any desired way they wanted any time. Also, the money are divided into categories like the onshore and the offshore Chinese yuan. The money that are spent domestically are known for the onshore, and then the offshore are used to trading overseas. While they have strict restrictions on domestic funds going offshore, they really have many ways. Generally, their words is about everything. But then, like most currency we have talked about earlier, capital flows generally falls into two categories, which are either based on expansion in businesses or save money on interest rate for China. Which, if the interest rate differences between the central banks like the People's Bank of China and other is big, other means like Federal Reserve for other countries, which is big, then the capitals might move their funds accordingly. We have come to an end already. Pretty much I've covered most of the basic details for you guys to get started from zero in Forex. I hope to grow with you guys, and therefore to continue our journey, I'll be sharing more valuable content to help all of us grow. And I hope you don't stop here.